So you might have heard Labour promise, we won't raise income tax. Labour keeps saying it, and on paper, they're telling the truth. The rates haven't moved an inch. But here's the sneaky thing at play here. Even though your pay increase might seem like a nice thing, a nice little boost, more of it slips into that higher tax bracket. That means you're paying more in tax without seeing any official announcement that the rates have crept up. It's a very quiet and creeping way that your income shrinks over time. Let me give you an example. Let's say Sam makes $60,000 a year and his pay goes up 6% to keep pace with inflation. All of that extra is now taxed at 40%, and for anyone who earns £124,000, even a small 2% rise, about £2,500, nudges them over into the additional 45% rate for that portion of their income. Now that's a serious chunk of money disappearing, all without anyone changing the headline rates. Tax bands in the UK aren't automatically adjusted for inflation. That's partly because the government can boost revenue without actually having to say that dreaded line, "We're raising the taxes." Economists dress it up as an automatic stabiliser, claiming it reins in spending and tames inflation. But let's be honest, that's just a technocratic fig leaf. For the government, it's an easy way to rake in extra cash without ever admitting to a tax hike. For ordinary workers, it's nothing less than a stealth pay cut. Fiscal drag doesn't just affect take-home pay, it can change the way people make financial decisions. When you know that every single pound extra earned could be taxed more heavily, it can reduce your incentive to take on overtime, push for a promotion, or negotiate a higher salary. And if millions of people are losing discretionary income, that can drag on overall consumer spending, which in turn can slow down economic growth. So it's not just your pocket it touches, it ripples through the economy. The key thing is planning. You cannot unfreeze the thresholds yourself, but you can make sure your financial setup works in your favour. Things like checking your payslip, reviewing your allowances, and considering talking to an accountant or tax advisor are important if you want to be strategic. Other than little steps like increasing your pension contributions or making use of salary sacrifice can make a noticeable difference over time. At the end of the day, Labour might say no income tax rises, and yes, that's technically true, but fiscal drag quietly eats away at every pay rise, every bonus, and every cost of living adjustment. If you're not prepared, that hidden tax could feel like a bigger hit than any headline rate change. Don't wait until your next pay rise arrives to notice this. You need to plan ahead. Use the allowances available to you and make sure you're keeping as much of your income as possible. Fiscal drag is real, steady, and if you're not careful, it hits your wallet in a way that's so easy to miss. To keep ahead of these tax changes that could hit your wallet, check out all our other tax update videos. We break down the key moves affecting self-employed people and small business owners, including big changes landing in 2026.